Something big is happening behind the scenes of global finance, and very few people are paying attention. The latest numbers coming out of the Federal Reserve have quietly sparked alarm bells among economists, because for the first time in more than a decade, the amount of U.S. Treasuries held at the New York Fed by foreign central banks has fallen below $2.8 trillion. That's not just a small dip. That's the lowest level since 2012. And here's the kicker. This drop happened fast. In just the past 2 months alone, foreign holdings have plunged by roughly $130 billion. Now, if you're not into economics, that might sound like just another random data point. Something you'd scroll past without a second thought. But this one matters, because it's not just a number. It's a sign, a warning that the world's trust in the US dollar might be slipping. See, other reports, like the Treasury's International Capital Data or the IMF's COFR survey, still make it look like everything's fine. They show strong demand for US assets. But there's a catch. Those reports are old. They lag by weeks or even months. The Federal Reserve's custody data, on the other hand, updates every single week. It's basically a live pulse check on how foreign governments feel about holding American debt. And that pulse? It's weakening. Rewind a few months to early 2025. Foreign ownership of U.S. Treasuries was actually at record highs. But since then, something has changed. Analysts at Standard Bank and Deutsche Bank have noticed a strange pattern. These sell-offs are happening while the dollar itself is getting weaker. That's the opposite of what usually happens. Normally, central banks start dumping U.S. bonds when the dollar is too strong. They do it to protect their own currencies from falling. But this time, they're reducing exposure even though the dollar's value is already sliding. That's not normal. That's concerning. Because what it might mean is this. Global central banks aren't just reacting to market swings anymore. They may actually be losing confidence in the long-term value of the dollar itself. If that's true, it's a much deeper issue. It's not about short-term trading. It's about trust. And if that trust erodes, the entire foundation of U.S. economic power could begin to shake. This is happening at a time when the U.S. dollar index, which measures the dollar's strength against other major currencies, has just seen its sharpest half-year drop in more than 50 years. Let that sink in. Not 5 years, not 10, 5 decades. From January to June, the dollar has fallen around 11%. The incredible dollar rally that started back in 2010, the one that made the U.S. currency the king of the world economy, looks like it might finally be over. So what changed? The truth is, the U.S. economy isn't looking as unstoppable as it used to. The government's debt-to-GDP ratio keeps rising, and there's no serious plan to bring it under control. The cost of paying interest on that debt is exploding, eating up more and more of the federal budget. Meanwhile, America's trade deficit and current account deficit, basically the gap between what it buys and what it sells to the world, are still huge. That means the U.S. continues to rely heavily on foreign money to keep funding its own spending habits. Right now, foreign investors own about $7 trillion worth of U.S. Treasuries, roughly a quarter of the entire market, and close to $18 trillion in U.S. stocks. So even if a small fraction of that foreign money starts moving away, it could put serious long-term pressure on the dollar. But let's be clear, this doesn't mean the dollar's reign is over. Not yet. The U.S. dollar still makes up about 60% of global foreign exchange reserves. Around half of all international trade is still invoiced in dollars, and nearly 9 out of every 10 currency transactions around the world still involve the dollar in some way. In terms of liquidity, stability, and scale, nothing else comes close. Yes, de-dollarization, the slow movement away from the dollar, is gaining speed, but alternatives are limited. The euro is too divided. The Chinese yuan is too restricted by Beijing's tight controls, and gold, while growing in popularity among central banks, simply can't operate as a modern payment system for global trade. So while the dollar's dominance isn't vanishing tomorrow, the signs of strain are undeniable. The cracks are forming. The trust that once made the dollar untouchable is being quietly tested by the very countries that used to depend on it. And if that confidence fades any further, we could be watching the beginning of a slow historic shift in the balance of global financial power. One that could redefine the next century. Let's talk about something big. Something quietly happening behind the scenes that could change the entire global financial system. The US dollar isn't collapsing tomorrow. It's not disappearing overnight. But make no mistake, the world is slowly preparing for life after the dollar. Central banks around the world are making moves. Silent, steady moves. They're buying gold. A lot of it. Not because they think gold will replace the dollar, but because they're hedging their bets. They're protecting themselves from what's starting to look like a shaky future for America's finances. Think about it. Gold doesn't pay interest, it doesn't print cash, and it doesn't run governments. But what it does do is tell a story of declining trust. Trust in Washington's ability to manage its debt. Trust in America's political stability. Trust that's been fading little by little for decades. The Federal Reserve has been trying to hold it all together. After the pandemic, it slammed on the brakes, hiking rates aggressively to fight inflation, and cutting nearly $2 trillion from its massive balance sheet. That brought temporary relief. But here's where things get tricky. Politics. The Fed is supposed to be independent, but pressure from politicians is building fast. The Trump administration has been pushing hard for rate cuts, again and again, even going so far as to try and remove a sitting Fed governor. That kind of interference sends a dangerous signal to the rest of the world, because once people start doubting the Fed's independence, they start doubting the dollar itself. Remember, the dollar's strength isn't just about economics. It's about trust. The global system runs on faith. Faith that America's institutions are stable, professional, and independent. But lately, that faith looks weaker than it's been in years. Now, layer on top of that a world full of uncertainty. Tariffs, trade wars, supply chain realignments, and the never-ending tension between the US and China. Together, these cracks are pushing countries to quietly rethink their exposure to the dollar. Central banks are diversifying, slowly stepping away, testing new paths. This isn't panic, it's strategy. And that strategy tells you something powerful. The world is no longer putting all its trust in one currency, one system, or one country. The dollar's position as the global safe haven has always depended on one thing: belief. Belief in American leadership, fiscal discipline, and stability. But that belief is starting to waver. What we're seeing right now isn't a crash. It's an erosion. A slow, deliberate fading of confidence in the US financial system. And that erosion could mark the beginning of something new. A multipolar monetary world. A world where power is shared, not dominated. Where emerging economies finally get more control over their own future. Economically and politically. For now, the dollar still wears the crown. But look closely. That crown doesn't shine the way it used to. It's slipping bit by bit as trust fades and the world starts to move on. If the latest data from the Federal Reserve is any clue, this might be the early warning. The canary in the coal mine. Foreign central banks are reducing their US Treasury holdings faster than they have in years. That's not random. That's preparation. So here's the question. Are you prepared? Are your savings, your investments, and your mindset ready for a world where the dollar isn't king? Because whether we like it or not, the shift has already begun. And when history looks back, this may be the moment we all realize the dollar's reign didn't end with a crash. It ended with a whisper. Let me know what you think in the comments below. Are we watching the slow fall of the dollar or just another temporary dip before it bounces back? I'd love to hear your thoughts. Thanks for watching. And don't forget to stay informed, stay alert, and stay ready for what's coming next. It feels like every time we blink, there's another twist between the US and China. Washington just can't seem to calm things down. But the funny part is, they also can't push too far without shooting themselves in the foot economically. So instead of jumping straight into those 100% tariffs, Scott Bessent's switched gears. He's gone on a worldwide PR mission, trying to convince everyone that China's the villain here. And honestly, it's déjà vu all over again. Janet Yellen pulled the same stunt a couple of years ago. Remember the talk about China's overproduction of EVs and steel? Same story, different spokesperson. Now Bessent's out here claiming China's rare earth restrictions are some big threat to global stability.